we'll eventually be Place Mortgage. We'll eventually become Place Mortgage and, get ourselves licensed in 50 states. And I think it'll be a huge part of your business going forward, having access to in-house mortgage. So that's how we got here. The last 8 months, I have been really just cleaning up the workflow and process, making sure that when we get a lead, we follow up with that lead with our No Lead Left Behind program, and then getting loans funded on time, right? That's the deal. So that's us, and that's what we're doing. And then Wes, you want me to just jump in here? Any other thoughts? All right, let's do it. So what we're going to do today is just go through like a mortgage fundamentals, just a lot. Wes wanted to walk through quite a bit of just basic mortgage stuff. And as he mentioned, but go ahead and throw questions in the chat, and we'll get to those kind of at the end. I'm going to move fairly quickly. We have a lot of slides here, so I'm going to just rip through some of this stuff. And then we'll get to the good stuff at the end and answer your questions. So a mortgage is a loan used to purchase real property. The interesting thing about a mortgage is secured by a deed of trust. So the lender actually has a security interest in the property, okay? And that lien stays on the property until it's paid. We qualify our borrowers, and you've probably heard, the 4 C's of lending, but really what we're looking at are credit score, how much money they have down, and their income, which leads to their debt to income ratio, so that we can calculate how much the mortgage, what percentage of their total income the mortgage represents. And based on programs, we can kind of flex there. And then finally, the property must qualify. So the way we look at this is that we qualify the borrower and then we qualify the property. I think appraisals have loosened up in recent times, right? We're able to get them quicker, but as you know, for the last couple of years, appraisal has been a significant issue. Now we're dealing with a lot of appraisals that are coming in short, but I think that's getting better and better. And I think in Tennessee, we've been in pretty good shape. So that's a mortgage, it's a lien, and we have to have a qualified borrower and a qualified property. The couple of terms I wanted to just level set on, because you're going to hear these things a lot, and they can be it can be kind of confusing. So the principal is what you pay on the loan, right? That's the actual money that goes to paying down the loan. And if you guys ever looked at this, the way this thing works is that before you're able to pay principal, you have to pay the interest, right? So we pay the interest, and then whatever's left goes to the principal. So your principal pay down accelerates over time, right? As the amount of interest you pay decreases. So then we have your property taxes and any of your county bonds. Wes, do you have a lot of county bond programs in Tennessee?
Not that I've seen here in the Nashville area. I don't know about the other areas.
All right, so it's one of the key gotchas, is making sure you understand the bond program. In California, for example, we have Melrose bonds. So every neighborhood has a different tax rate, and that's not always captured. So you want to think about what your property taxes look like when you're shopping. And then insurance is required on all mortgages. So, and then finally, we have if there's homeowners associations. So we call that the PITI, principal, interest, taxes, insurance, and then we tack the homeowners insurance on there as well. Typical loan terms, 30, 20, 15 years. The shorter the loan term, the higher the payment. It's pretty simple. The most traditional loan is 30 years. Fannie Mae, Freddie Mac are working on 40-year loans. They're discussing it actively. I don't know if it's going to happen or not. I know some private community banks and credit unions are offering 40-year mortgages, but once they offer that on the conforming side, I think it will help further lower people's payments and drive increased affordability. So the second most popular is a 15-year. We don't do many 20 years, but we can actually do 22, 23, 27 years. We can actually set the term on loans. We typically do that on a refinance if someone doesn't want to reset back to 30 years. So interest rates are either fixed or adjustable. Right now, we are still primarily in a fixed rate market. Adjustable rate market accounts for less than 10% of the total market, which is a little bit surprising. But the underlying issue there is that on the secondary market, when we sell the loans in these big bundles to investors, they are less interested in adjustables right now because rates are trending up so aggressively. So pre-qualification and pre-approval, the difference between pre-qual and a pre-approval is fairly important. A pre-qual means that your MLO looked at stuff, looked at some of your borrows things, and has an unverified automated approval. So pre-qual is basically run it through our LP and DU system. loan prospector and digital underwriter. Those are the Fannie and Freddie automated approval systems. And then, and the other term you'll hear is AUS, automated underwriting submission. So that's a pre-qualification. So we've had an MLO that's looked at some things, but they're not fully verified. A pre-approval is fully documented, underwriter approved, and we call these full TBD approvals, to be determined. That means they don't have a property. So a full TBD approval is certainly a valuable thing if you're working on getting an offer accepted or you're in a highly competitive market. So you just want to make sure you know what you're looking at and the difference in those things. The debt to income ratio, which we talked about, is really one of the key drivers, especially right now with affordability. We had about 30% of our total TBD pipeline, so our approved pipeline, that lost the ability to qualify under their original submission when rates went from 3.25 up to about 5.5. So that's 30% of the market that wasn't able to qualify for the same loan amount they had, back in November. So we're watching that very closely. We're talking about it a lot, but DTI. So you talk to your loan officer, they go, the DTI is too high. That's the debt to income ratio. And then closing costs. We have two types of costs. We have recurring costs that are going to be the same no matter what happens. And we have an example of a fee sheet in here a little bit later. And then we have interest taxes that are just going to keep going no matter what. And they're all the same regardless of lender. And then we have non-recurring costs, and those are the lender fees, title, escrow, reporting, and appraisal. So those are the two types of fees. So I want to just give you level set on some terms as we get into this. The typical, every time we need to approve a borrower, right, a potential buyer, we need to verify some things. We verify their income, their assets are the two most important pieces. So, when you doing a loan it's still painful. It's getting easier with technology and some of the tools and resources that are available, but we generally need someone's bank statements. We need their W-2s. We need any tax returns that they have. If they're divorced, we need divorce decrees. If they have rental properties, we need rental agreements. So what we do is we think about this, and the way we communicate with your buyers is say, listen, in the first 48 hours, it's really important you get us everything you need. And we call this our first 48 program. We want to ask all these questions so that, so we can avoid challenges later on in the loan transaction. So we oftentimes need our agents' help. And when I say we, I'm referring to the lending industry, right? Beyond BKCO. This stuff applies regardless of who you're using or what you're doing with your mortgages. But we really do need your help motivating oftentimes our buyers to get everything into the system in the first 48 hours. And we focus really hard on that. And we tell them, hey, listen, these 48 hours are going to be horrible. I need you to log into all your bank accounts. I'm going to ask you for stuff that you didn't even need when you did your last $4 million life insurance policy. But if you get me all that stuff, then your loan goes a lot smoother. Okay. And same thing you guys do when a deal goes under contract, right? So we need to do our first 48 intensive before we go into contract, and then you guys have your 48-hour intensive as soon as you go into contract. A lot of different loan products. Here's the reality. There are 1,000 products. Most loan products are generally used for marketing. The majority of loans in the United States that are going on right now because of this market are conventional 30-year fixed interest rates or traditional FHA 30-year fixed interest rates. But I'm going to go through some different products, and we're going to talk about the conventional fixed, some adjustables, FHA, VA, USDA, jumbo, and assumable. I think when you think about products as a real estate agent, I want you just thinking about the borrower and how qualified are they and what's their situation. And then your MLO will be able to do an analysis and show your individual buyer what makes the most sense for them. The reality is we do a ton of analysis work in this space, right? We do a lot of side-by-sides. We do all these comparisons. The best deal for your consumer is generally conventional 30-year fixed. And there's a lot of reasons for that, but we'll get into those in just a second. So the conventional rewards higher credit scores. It's definitely, as I mentioned, the most common. There's fewer requirements on the appraisal. So when you think about conventional loans, FHA and VA both have very strict home guidelines, right? What does the home actually look like? Does it meet FHA, VA requirements? The other thing we can do is if we're putting less than 20% down, the PMI can go away, right? So you can actually request that we drop your PMI. PMI is private mortgage insurance. So anytime you put less than 20% down, you end up with private mortgage insurance on a conventional product. And the downside here is that we require a higher credit score. And oftentimes we do require a higher down payment, or the higher down payment will have more of an advantage. We do have some 3% conforming products with 3% down, but like on VA, you can go to 0. So on the ARM side, right now in the market, and if you're seeing in, I'm trying to think, there's a great community bank in Tennessee that's doing a good job with ARM products right now. Right now, our ARM products, so adjustable rate mortgages, are not as competitive as our 30-year fixed, or they're about at the same rate, right? And when I say ours, I mean mortgage banking. We do expect, as yield curves invert, I'm not going to get too deep into this, but as the economy changes, we expect that an adjustable rate product will become more advantageous here coming into the summertime. So you're going to see more what we call 5/1 and 7/1 ARMs. That means the interest rate is fixed for 5 years and then becomes an adjustable after that, or it's fixed for 7 years and becomes an adjustable after that. So you will see that product in the market. We have a hand up down there.
Yes, I just appreciate you for being here. So yeah. Some of my agents are like 12 years old and started real estate 2 seconds ago. And so when you say ARM, what does that mean? And what is the pros or the cons? What are the pros or the cons for an adjustable rate product? Because this is something that they will not have seen yet.
Sure, perfect. So ARM stands for adjustable rate mortgage. And what that means is that the interest rate on your loan is subject to change. When the interest rate changes, your payment actually changes. So what happens most of the time with an ARM, the way they're created, is that your interest rate goes up. So traditionally, we used a lot of ARMs to help people qualify for a loan, right? Knowing that their income was going to increase. So we have to be judicious in the way we use these products because it can create a lot of danger for your borrower. And when I'm talking about interest rates going up, I'm talking about 1 or 2% increases in rates, right? They're typically capped at 1% a year and 6% over the life of the loan. So if an interest rate goes up for every year for 6 years, we're talking about thousands of dollars, depending on your home value and your loan amount. We're talking about thousands of dollars in increase in payments. And this is a big part of what happened to us in 2008 with the market collapse. And anybody that's been in the business for 2 minutes doesn't remember this, but I bet Wes was there, and it was not pretty, right? And so a lot of that was caused because of loose lending practices associated with these adjustable rate mortgages. Now, the advantage, like in a market like this, is that we are at a very high interest rate and we think it hasn't peaked yet, but once it peaks and it comes back down, we can refinance somebody out of those adjustable rate mortgages. So just to be clear, adjustable rate mortgages represent less than 10% of the market right now. We're seeing a huge increase. I mean, it was like 1% last year at this time. But it's there we go. I'm unmuted. Sorry about that. So it's about 10% of the market. I think we'll see that get to about 25% of the market. So the key disadvantage is that income. If your income isn't scheduled to increase at the same rate as your mortgage, you can get in a lot of trouble, right? And a lot of people got in a lot of trouble in 2008 because of these products. All right, I hope that helped. I got to get going here. So FHA loans are guaranteed by the federal government. There's oftentimes a lower down payment option. You can buy multiple properties with FHA after a 2-year wait, right? The big advantage of FHA when we use it most of the time is when someone has a lower credit score, because we can get somebody a better interest rate with a lower credit score. There are certain home requirements. So your home must be approved by FHA, and these are fairly basic. The home has to be safe and functional and not have any major defects. So like all your section 1s on your pest have to be clear. So this is why I think in a hot market, people have not liked FHA for 2 reasons. Number one, it takes a little longer to get an appraisal. it has, I should say, in the last couple of years. That's changing. So with volume dropping, those appraisal issues are evaporating, but the home has to be in better shape. So if you have an FHA buyer, it's important that we advocate for those buyers with our sellers. Okay. And the two things we can tell them is that, hey, I have an FHA buyer, but they're in very good shape, and we did a full approval. So you want, in this market, you want to get your FHA buyers fully approved, and just let them know that, hey, the appraisal turn times are coming in line. We can get an appraisal in 7 days. So you can still write a nice short contract on an FHA deal, and it really does empower home ownership. So we love FHA loans. We love to do them, and the borrowers love them as well. So VA loans, I know you have several opportunities here for VA business. VA loans are phenomenal. And again, difficult to get approved by the seller, but that needs to change as well. And it's our job in this business to advocate for our VA buyers. VA loans have 0 down options. You can also do jumbo loans with VA. So we can do high balance VA loans. So we closed like $1.5 million VA loan in Washington last month, and with basically a conventional interest rate. So they're very, very good products. And it's one of the first questions you should be asking all your buyers, or they'll usually tell you, because VA advocates for the VA product. There's no PMI on those. There is a funding fee. And then there's pretty strict requirements on the appraisal side as well. So VA takes their duty of protecting veterans very seriously. So if you have any material defects in the home, those are going to need to be fixed, repaired, or dealt with under a VA. And they're even more strict on the VA appraisals than they are on the FHA. So if you think about it, like if you have a home with a couple of defects, we want to target conforming, and you guys are mostly a VA market. Sweet. Well, you guys know about VA loans then, and it's really about eligibility of your veteran. There's a bunch of cool things you can do when someone has, if someone unfortunately was disabled, they get more entitlement money, and they can buy bigger homes. There's all kinds of fun stuff we can do with VA. So it's definitely a valuable product worth marketing and talking about on a regular basis. USDA, basically a 0 down loan. The Department of Agriculture funds those. I know you have quite a bit of ag land. The downside, so USDA is kind of one of these specialty products, right? When it works really well. Doesn't always work. So there's income limits, there's home valuation limits, and there's limits on zip codes. So it's a very specialized product, but it is a great product if it works for your buyer, and your buyer has lower income and they're shopping for a rural property. USDA is just a phenomenal product. Because you have a lot of VA loans, we want to talk about this assumability. This is really coming up. This is coming up a lot. So VA assumability is, well, let me back up. FHA loans and VA loans are both assumable. This will become important as our market continues to shift. What you need to do there's a couple things you need to know. It's really not that difficult. Your buyer will go through a normal loan transaction. They just go through that transaction, not with your favorite MLO. They go through it with the bank that currently owns the loan, okay? So they're gonna do a normal loan transaction. They have to qualify the same way they would. The advantage is that they get to keep whatever loan amount is there and whatever interest rate they had. So this becomes important because, if someone had a 3% VA loan they secured 2 years ago, your buyer can assume that 3% loan, and then the entitlement actually transfers. So the seller gets their entitlement freed up, takes a little bit of time. So your buyer will basically apply through the current lender. They have to be approved as per normal, and then they will basically just assume, it's exactly what it sounds like, they assume that loan. Now, the problem with this loan product in today's market, and everyone's talking about it, but what they're not talking about is if you have a $500,000 home and the previous veteran only owes $300,000, you have to come up with the other $200,000. And VA and FHA do not support subordinate financing. So there's a big down payment requirement here that is required, right? So you can get that in the form of a gift. There's some ways to close that gap, but that's the biggest issue. So when you have a seller, you definitely want to ask, do you have an FHA or VA loan? Because it's a good marketing technique. It's a great way to create traffic in a home. But the reality is we're not doing a lot of these right now, but it will. Everybody's talking about it because rates are at 5.5. And, if a veteran is sitting on a 2.5, 30-year fixed loan that they paid 4 years on, that's a very attractive loan product. So if you have a veteran that's well-funded, that has some money or has the ability to get a big gift, it's definitely worth looking at because they could save thousands of dollars on their transaction. All right, jumbo. Jumbo loan is anything over the conforming loan limit. Loan limits are different by county. They're around $647,000. Interest rates on jumbo loans today are very close to conforming loans. They're just more difficult to qualify for. They just take more effort, and they create a little more transactional risk. So we love jumbo loans. I mean, sometimes they're the only option you have. We're doing a deal for one of your fellow place teams in Seattle where they have six new builds that are all jumbo. And we're having a lot of success with jumbo. You need to find the right lender for sure. Not everyone does this well, but when you have a bigger home, you're not in FHA and conforming loan limits for your county, you need to pop into the jumbo side. And then land loans. Financing land loans are interesting. So they really don't fit in the bucket for us. And the reason people always ask, what's wrong with land? I want to buy some land. Why is it so hard to find financing? Well, remember, the only security that the lender has is in the property itself. And if you stop paying, they have to foreclose, and then they have to sell that property to get their money back. So bare land is very difficult to sell. So therefore, the restrictions are higher. We can generally do loans with, you can do loans with foundation on land that has foundations or partially built properties, or raw land is actually a lot easier. In the event you have a piece of land with a foundation or some infrastructure on it, you're going to need to get mechanics, liens, releases. And the best source for land loan lending are generally community banks, right? So your local bank usually has a good land program and a construction program. Some mortgage banks do as well. And then some larger 50 state banks. Yeah, we need a good land lender in Tennessee. It's very regional. So if you have one, throw it in the chat for me if you don't mind. Like in the Northwest, we use Umpqua Bank, right? They have a 50% down land loan. It's the cleanest deal. It's the cleanest deal on the West Coast. So you're going to want to find one of your community banks for those. All right. And we also have Sharia compliant lending, which is something that may pop up for you. We have actually 2 of these we've referred out this month, which is a new record for us. Usually we do 3 or 4. So the way this works is under Sharia law, you're not allowed to pay interest, right? Which is a real problem for buying a home. But the Islamic community still wants to buy houses. So there are very specific organizations that build these structured partnerships, buy the home in either the buyer's name or an LLC. They're all a little bit different. So you have to look at them. I recommend, if you end up in one of these situations, you want to have a good MLO that you trust, look at the terms for you to make sure that it works. We have a company in Texas, I can't remember their name right now, but I can get it to you later, that does these for us in all 50 states, and their program is actually pretty solid. But it's funny, if you're running around and someone asks, do you have a Sharia compliant loan program? Usually most of us go, what the heck are you talking about, right? But they do exist. There's also there's a couple of religions that have the same limitation, and you can use the Sharia compliant organizations for those transactions generally. Okay, so another type of loan that we're seeing more of, and just as a general category, you're going to hear this called non-QM, so non-qualified mortgage. These are not FHA or conforming loans, and one of the most important version of this is our kind of income-based loans or bank statement loans, right? So what happens is, self-employed, you guys are real estate agents, you all understand this. There's a fine line between optimizing your tax performance and showing enough net income to qualify for the house that you want, right? And you can afford. So what we've been able to do, and this is kind of a touchy subject for some of us who have been in the business a long time. There's a couple ways to do this, but generally speaking, we'll use bank statements. So we'll use like 12 months or 24 months of bank statements showing consistent deposits, and we'll use that as their income. And there's other programs like on an investment property, you can use the rental income to qualify if there's enough cash flow in the property. So there's this whole bucket of non-QM. We could probably take 4 or 5 hours to go through it. But basically, when they don't fit into a conforming or FHA bucket, we start looking outside and we look at non-QM loans. And the bank statement loans are really the most often utilized program that exists out there. A little more difficult to qualify for, a lot more paperwork, but generally what we do is we go, hey, listen, I got good news and bad news. The bad news is you don't qualify for the easy loan. The good news is we'll get you a house, right? And then we just start our process from there. All right, so I want to go through a couple of products for this market. We're at 30 minutes. Wes assured me I have about 45 or so we'll keep rolling. We want to find solutions, right? The market's slowing down. I mean, even in this on fire Tennessee market, we're seeing a little bit more inventory. We're seeing fewer offers. For you folks that are listing houses, they're sitting on the market for a few more minutes. So it's time to get creative. And we're starting to see this happen a lot on the West Coast. In California, Oregon, and Washington, we're required to get creative. So a product that exists in the market that we actually have access to is a lock-in shop. And a lot of people are talking about this. I don't know how I feel about it yet. It's a little bit expensive, but you can basically lock your interest rate for 60 days without a property. That allows you to shop with interest rate certainty. So depending on the type of buyer you have, right? We have an engineer from Lockheed who took one of these lock-in shops, and they said, hey, listen, I think rates are going to go to 9% in the next 90 days. And I don't believe that's the case, but you can actually take that lockout and protect your interest rate. Okay, there is some cost involved. Each program is a little bit different. We do have one that we can engage in if you have someone that's really rate sensitive. The one we're using and we're talking about, like in our Monday email last week, we talked about this 2-1 seller buy down. And you guys, if you want like the scoop on mortgage, I met with Chris Suarez. We're going to reorganize our Monday email. It's a big, long kind of digest, but in that we have a product spotlight, and we're talking about all these products that we think matter for you as a real estate agent when you're marketing your properties. So the 2-1 seller buy down is pretty important. The seller actually contributes and pays some of the interest for the buyer for a period of 2 years. So the example is if rates are at 5.5 today, the start rate for your buyer is 3.5. We still qualify them at 5.5, and the seller actually pays that difference. So the seller pays like between $2,000, $3,000, $4,000, and you can essentially market a 3.5% 30-year fixed interest rate start rate. We can help you with the marketing on your listing. So it's incredibly valuable. And oftentimes when you have a young buyer that has a good solid career path, having a lower payment for the first couple of years is very helpful. The other reason we like this product right now is that in the event we end up in a recession, which feels likely today, interest rates are going to come down. So we'll just refinance these people and they'll never even see 5.5%, right? So that's how we're thinking about that product. The assumable loans we've already discussed, intermediate arms we've already discussed. And what you're going to find is that your community banks are offering these 5-1, 7-1 arms at a very low rate. Some community banks, right? And what they're doing is they're actually putting those loans on their balance sheet. So they have too much money, right? Community banks right now are overfunded and they're required by law to lend this money out. So one of the ways they're doing that is with 5-1, 7-1 arms. So you'll see those not so much at, Fairway, American Pacific, or BKCO, but you'll see a lot more competitive rates at your community bank on those products. And then there are bond down payment assistance. I know, I think Tennessee Housing Authority has a product, but I don't think, I talked to Wes, I don't think you're doing a lot of down payment assistance right now, but this will become more important as time goes on, right? As affordability continues to decrease, we're going to need to be more conscious of bond programs. So we are not approved for a bond program in Tennessee at this time, but we're working on a program called Chenoa. And the way this works is that you basically do a 3% down conforming or FHA loan, and then you get a grant for 3%. As long as you're in your house for a certain period of time, they forgive that grant, or you pay it off when you sell the house. So it's a way for us to get to 100% financing, typically for first-time home buyers, pretty easily. All right, and then last thing here, lender credits. Listen, when you don't have 50 offers on a house, and I know many of your markets are still really, really hot, but it's slowing down. So you know that, we've been talking about it. Your lender can offer up to 3%, sometimes up to 6%, depends on the situation, as a credit to the loan for your buyer. And this is a great way just to create an incentive and keep home values up in your market, right? So think about that. When you, instead of lowering prices, offering seller incentives improves the situation for your buyer and keeps home prices where we want them to be and where we think they should be in your market. All right. So shopping for a mortgage, you know, this comes up all the time, right? And I don't know if you guys in Tennessee are required to refer 3 people, or you know who your typical go-to lenders are. I know we're doing business with quite a few of you, and I appreciate that. It's more than just a rate, right? So when you communicate with your buyer, I want you to talk to them about a couple things. Hey, listen, when you're shopping, it's important to shop for a mortgage. This is one of the largest financial transactions of your life. The other thing I want you to keep in mind is that we are entering into a 30-day or a 21-day contract. And it's important that we close on that and we close on time. And there's 2 things. Number one, we want to minimize turbulence during this transaction. This is a tough transaction. We have enough to deal with on the real estate side. We don't want stress on the mortgage side, right? Or we want to minimize stress. And the other thing, it's important that you close on the rate you were quoted. There's a lot of people out there quoting, you know, they'll quote anything or they'll quote a product that's not best for you. So when you shop for a mortgage, we want you thinking about, can we close on time? Are you going to close with the rate and fees that you were quoted? And then how is that lender going to handle turbulence, right? So it's kind of 3 things you want to triangulate in on when shopping. And listen, you can always find a lower rate, just like when you're shopping, you know, when you're shopping around for a, you know, $100 item, you know, you're shopping around for something that, thinking like something is relatively commodity based, there's always somebody that has a lower rate. The question is really, you know, which business are you going to support and what's the likelihood of that thing showing up as advertised, right? So it's important that we improve the intelligence of our mortgage shoppers. And I'll give you an example. You know, Rocket is a great company. They have a great loan program. We've taken 2 loans from Rocket and 1 loan from Umpqua, which is a phenomenal organization in the Northwest. They're a bank. Just in the last couple of weeks, because they just weren't calling people back, and we were going to miss close of. We had agents that were going to miss close of escrow dates. So the buyer chose that direction. And you know, Rocket's an interesting one because their rate is really good, but their on-time close rate is like less than 50%. So when you see one of these Rocket loans, if you have a perfectly squeaky clean buyer, no problem. If there's any hair on that transaction, there's a possibility that it won't close on time, which puts our earnest money at risk and just creates stress for the entire transaction. You as a real estate agent, how many phone calls do you want to make on your mortgage side, right? How many phone calls do you have to make today to get a transaction closed? And how many more do you want to have to make, right, if you have a deal that goes sideways? So that's the way to think about shopping. The big issue is credit pulls, right? People are being pounded, don't pull your credit. The laws changed about 4 years ago. So that any credit pulls that are similar within a 30-day window, don't ding you. So if you're shopping for a car, shop for a car, do it in a 30-day window. If you're shopping for a mortgage, same thing. It won't ding you. And then what we tell people, hey, listen, price is what you pay, value is what you get. I know it's very, very, very attractive to use, you know, strange lender from Los Angeles that's advertising a 3% 30-year fix. The chances of you landing on that rate and closing on time with one of those consumer direct rate table lenders are still very low. And there's a lot of noise in the market right now. So you as a consultant for your buyer just need to be aware of thoughtful shopping practices, right? And I'm not advocating necessarily for BKCO, although we do close with a 95% on-time close rate. And we have a program we call OTC, which is on-time close, where we track 6 dates. So we've engineered our whole system for purchase. If you're, you know, we'd love to work with every single one of you, but if you're working with other lenders, just make sure they have a system that's engineered around the uniqueness of the purchase transaction so that you can close on time. Because I mean, any of you that have done transactions have spent a full 8-hour day working on one transaction. It's not fun, right? It happens to us every once in a while, and it's just not fun. So you want to decrease stress in your transaction. All right, the other thing, I want to just show you a sample loan comparison. This might be a little bit small, but the other thing when they're shopping for loans is you want to compare apples to apples. So there's oftentimes, and Wes has been using this example, and I absolutely love it. It's from a few years ago, but what we do at BKCO Mortgage, and some other lenders do too, so this isn't incredibly unique, is that we basically waive all of our lender fees, plus we give your buyers $1,000 credit. And we do that for two reasons. Number one is that we will, number one, we want the loan shopping experience to be very clean, right? Because if my rate's 5.5 today, I can charge you $4,000 and kind of hide it in different fees and give you a 5.25, right? But those fees, like, what's your recapture period on those fees? And how much confusion does it create in the transaction? And how much cash do you have to bring to the table? So, like in this example, a traditional lender will charge a processing, underwriting, and full credit report fee. The prepaid interest, remember, those are recurring charges. We all have the same dollar amount. And in this example, these folks used the wrong closing date and quoted their prepaid interest a little bit low. So the amount of cash this individual will have to come up with will be higher at the close date, right? So we're basically looking at $502 versus the $6,500 in fees, and then we compare rates. So we look at other LEs all the time, and we do this comparison, and they say, this other company is better than you. We look at it and go, okay, well, listen, here's the deal. This other company looks better than us because they're trying to sell you. And the way we approach it, and any good lender that you're working with should approach it, is that they're your partner. So there is no, air quotes, bait and switch. There is no under quoting taxes, insurance, or interest on our end. So when we send an LE, we're pretty darn accurate. We take great pride in it. And any good MLO that is working with purchasers, with buyers on a regular basis, will do the same thing. So it's always important to compare apples to apples. For you as an agent, you want to protect your transaction. And I'm going to give you just a couple of tips here. In a hot market like you have, you want to get your buyer pre-approved early. And, it may be a pre-qualification, like an audit, but depending on the buyer, right? So we look at this from a buyer perspective. If they have a really good credit score and a standard W-2 job, and I run that automated underwriting, you're good to go. So a good MLO will know exactly what that looks like. But you want to start early, right? Before you get in the car. And there's a lot of techniques, and each of you as operators have your own, and agents have your own strategy here. Most people will say, listen, I'll happily show you one house, and then I need a full pre-approval letter. Or they just say, you know what, before you get in the car with me, you need a full pre-approval letter. The other thing you want to do is you want to understand the strength of credit package. And this is an interesting one. So you're out shopping for $350,000 houses. You have a pre-approval in your hand. Is that pre-approval pushing them all the way to the edge, or could they go to 400? If rates go from 5.5 to 6%, do they still qualify? These are the questions you want to ask your loan officer. You want to know, okay, am I dealing with a buyer that's right on the edge? There you go. Zillow agents are definitely showing houses first. Be careful. So the question is my buyer on the edge, or do I have a little bit of room? And that's a conversation you need to have with your MLO. When you have that understanding, then you can advocate for your buyer really, really effectively, right? So if we give you a $350,000 pre-approval and we say, this is it, $1 over, and this is not going to work, you know what you're negotiating against, right? So when they want to see that $475,000 house, you can work with us to make sure we keep them going in the right direction and don't create disappointment. Lending is hard, right? The real estate business is hard. Lending is hard. We end up with over 17 individual people that touch a loan transaction. We end up with buyers that don't understand their own financial circumstances, right? Things like child support, how they're structured. What does the MSA say? I mean, we go pretty deep with people. I mean, we get houses, right? We get an FHA house where there's rot on the deck, right? That's going to create turbulence. There's a lot of turbulence in the loan transaction. The thing I would tell you is that when you have the right lender, they're working on it. And you want to manage that turbulence with grace. The problem that we have in the loan business is that, if we have a guide, so we make mistakes like everybody. You want to ask the right questions. Hey, did somebody make a mistake? That's fine. Let's fix it. Or is this an actual guideline issue, right? So if you ask the right questions, you can really identify what's going on with this loan transaction. When you ask the right questions, you then can work with your MLO to cross the finish line. You guys, we can solve a lot of problems. Sometimes time and money solves every problem, which is good. But you want to be able to if we can work together, right, you can actually get through these things easier and then end up creating a win. So one of the things we do is when we have turbulence, we go like, hey, turbulence alert. This is what's going on. This is what happened. It was either a people, process, or system, break or miscommunication, oftentimes on the buyer side, right? So buyers create most of their own turbulence, by the way. We work hard to avoid that. And then once we understand people, process, system, then we can get to a solution and we can work through it, and we look like heroes in the end. But if you end up in a confrontational relationship with your lender, or there's other, you bring a lot of a negative emotional energy to transaction, it really sours the transaction. So I'm sure, Wes has a whole series of trainings on this for you guys in the real estate business, because you deal with more turbulence than anybody, but dealing with this stuff with grace is important. The other thing to remember is we don't really say no, right? We just ask how. So when someone wants to buy a house and they don't qualify, cool. Do you have someone that can co-sign? How much do you have somebody to give you a big gift, right? Can we look at, a little smaller condo? So it's important to always ask how. And we manage a system of long-term follow-ups. So we have, about 600 people that are going to buy someday, right? We have them on some type of home purchase plan, but we don't ever want to say no. When we tell people, hey, unfortunately, today you don't qualify for the $600,000 house. I can qualify you for $550,000. But when you add $600 a month to your income, you're going to qualify for that next house, or you need to get a gift for $100,000. So we'll help them kind of structure the how. And it's not always practical, but there's always a way, right? So when someone asks, can I qualify for a house? Of course you can. I don't care what your situation is. We'll get you qualified. The question is, are you willing to do what it takes to get there? The last thing, hope is not strategy. And this is a trap that I think we fall into, especially working with lenders, for you as real estate agents. If you're not getting clear answers to your questions, if someone goes dark on you for a couple of days, that's never a good sign. It's not a good sign. As a real estate agent, don't hope everything's going to be okay. If you expected an appraisal on Tuesday and you haven't heard by Thursday, figure out what the heck's going on. Something happened with that appraisal. If you expected underwriting approval on Tuesday and you don't have it by Thursday, something's going on. So as an agent, you want to make sure you're again asking. I think I put asking the right questions in here twice. It's important you ask the right questions. Like, hey, what's going on? Why are you dodging me here? We need to figure this out for our buyer. So those are the things you can do to protect your own transaction and decrease turbulence throughout. I guess the last part is actually partnerships. Having a partnership with your lender is important, right? I mean, they have the highest level of influence over your real estate transaction outside of you. So make sure that you're, working in tandem with them to get the problem solved. All right, Wes, we're just over 46 minutes. Do you want to take a minute and run through some market stuff?
I just want to touch on first, that's a lot to cover in 45 minutes, as you all will agree. And thank you, Jesse, for bringing all that energy and also doing that in record time. I think that was faster than the Indy 500 a week ago. So thank you for that. It is going to be on our YouTube channel, on our Tennessee Power Up, so you guys can go back and view this. I will share the slides. I did want to also say that next week, we're going to have a script off, and I need you guys to give the biggest objections you're getting right now to your team leaders, so that they can get those in, so we can give those to them ahead of time. Like, I'm going to wait till interest rates go down before I buy, or everything's selling so fast right now, would you sell it for 4.5%? And of course, that's when we gag and run out the door because we're going to vomit. Okay. But those are kind of things that I want you guys to get those objections that you're getting to your team lead, so we can get those handled for you and show you what to do. I don't want to keep you guys. I know we want to get to prospecting. Jesse, just a super bringing your A game today. I so appreciate it.
There we go. Now I'm unmuted. Thanks for having me, you guys. Go get it.
Good stuff, Jesse. We appreciate it, man.
Mm-hmm.
All right, go get them. Thanks, guys.
Thank you.
Shout out from New Orleans. What's up? Let's go.
All right. See you guys.
Go get them. Bye.
Thank you, Wes.